Private equity funds, or PE funds, have become a powerhouse in the investment world, offering unique opportunities for both investors and companies seeking capital. In this video, we're going to dive into the details of the fund structure. We will focus on the key parties involved, the reasons for LP structures, and the various type of fund structures, and the various factor of the choice of a structure. If you are in the private equity industry, you probably see this image everywhere. So this is a very basic limited partnership structure. And these are the key parties here: general partners, limited partnerships, and the investment or the portfolio companies. GP is the private equity firm managing the fund. The GP makes investment decisions, manages the portfolio, and is responsible for the fund's overall strategy and operations. Limited partnerships. This refers to the fund itself. Limited partners. These are the investors in the fund, often including institutional investors like pension funds, endowments, and high net worth individuals. LPs provide the capital but have limited involvement in fund management. Portfolio companies. These are the entities receiving investment from the fund. They are the target of the fund's investment strategy. So in this basic structure, we will have investors pull all the money together into the funds. Then the funds will acquire some interest of the other companies. The fund will have ownership of the portfolio companies. And then once the portfolio company generated either income or any distribution come to the fund will distribute the net proceeds to the investors. So why? Why this structure? What's the benefit of choosing the limited partnership structure? So there are a few reasons. There's a tax benefit, and there is a general partner control. There's limited liability, and there's a good flexibility. So for tax benefit, this structure offers a significant tax advantages by avoiding double taxation. Unlike a corporate structure, income is taxed only at the investor level. The funds is treated as a pass-through entity, meaning it doesn't pay tax itself. Instead, profit and losses flow directly to the partners who report their shares on their individual tax return. So for example, if a fund generated $100 million in profit, it distributes this amount to the partners based on their ownership of the stake. Each partner then includes their share on their personal tax return. Importantly, these profits are often taxed at a favorable capital gain rate, potentially resulting in substantial tax savings for investors. And the general partner control, so GP manages this fund, while LPs have limited involvement, typically only in advisor roles. This allows efficient decision making and leverage the GP's expertise. Limited liability. GP's losses are capped at their committed capital, while GPs assume greater risk. This protects LPs from additional financial exposure beyond their investment. Flexibility. This structure offers significant benefit and flexibility, especially when funds are structured as LLCs. This allows for customization based on investor needs and regulatory requirements. Private equity funds come in various structures, each designed to meet specific needs and regulatory requirements. So this little visual here lists 5 different structures. So the one we introduced just now is a standalone fund structure. This is the simplest and most common structure, consisting of a single fund entity. So for example, Blackstone Capital Partners 4, it's a $30 plus billion buyout fund. This massive fund focuses on large-scale acquisitions across various sectors, leverage Blackstone's extensive resources and expertise. And for master feeder structure, I will walk you through this little image here. This structure consists of a master fund and one or more feeder funds, onshore and offshore, that invest into the master fund. So this structure is designed to accommodate different type of investors efficiently. So for example, the investors could be taxable investors from the US or foreign investors. Investors will pull the money into the feeder funds and then invest in the master fund, and the master fund will acquire different interests of the portfolio companies, and then the distribution will have the same flow through structure. And for fund of fund, these are the private equity funds that invest in other private equity funds, providing diversification at a potentially lower risk. So there was the example is like Harbor Vesta Global Private Equity. This structure allows investors to gain exposure to a broader range of private equity investments through a single vehicle. Parallel fund structure. So this involves multiple funds running in parallel, often used to accommodate different investor types of regulatory investment. For example, KKR North American Fund 6, which has parallel vehicles for US and non-US investors. This structure allows KKR to manage a single investment strategy while meeting different regulatory and tax requirements for various investor types. And then we have alternative investment funds, or AIF. This is a regulatory classification in Europe of funds marketed to professional investors. So the choice of fund structure is not one size fits all. Several factors come into a play. We would have the tax consideration, have the regulatory requirement, we have the investment strategy, asset types, and the investor types. So for tax consideration, different structures can have varying tax implications for both the fund and its investors. And the funds must comply with regulations in the jurisdictions where they operate and raise capital. And for the investor types, think about the mix of a domestic and international investor can influence the optimal structure. And the fund's focus, either buyout or venture capital or real estate, can affect the structure decisions. And then asset types, as the nature of the investment, like either equity or debt or any other type, can impact the choice of a structure as well. The limited partnership structure, with its distinct roles for GPs and LPs, provide a framework that balances control, liability, and potential returns. The various fund structures allow for flexibility in meeting diverse investor needs and the regulatory requirement.